Now, Anheuser-Busch missed estimates, but Phil, of the S&P 500 companies that have reported earnings so far, 68.6% have beat estimates. What do you say to that?
That is impressive, Michelle. I mean, obviously, we're at record highs here for most of the marketplace, but there's some big questions to ask, and someone's going to help us answer that is Neil Hennessy, CIO and president of Hennessy Funds. Welcome back to the show. It's been a while since we've had you back on. I think last time the market was significantly lower. Michelle just mentioned it. We're at record highs. And I know we can talk about some of the numbers later, but I want to get to a real general question that perhaps every retail investor out there, whether you're in the United States or you're in Beijing or you're in London, that's asking this. They've probably been underinvested over the past couple of years. They've watched this rally happen on television, whether you're watching CCTV or any other station, and they're thinking to themselves, well, do I get in now?
Well, I mean, Phillip, I think you really got to look back the scare tactic that they're still dealing with, which is March of '09. So the market's rallied over 100% since March of '09. Those that stayed in now are taking some money off the table. Those that haven't been in are contemplating putting money into the market. And they're scared because on every daily program that comes out, somebody's out there saying, well, the market should go down. And it should go down because it's run over 100%. But they're not giving you any real fundamental news of why it should go down. And you can look at the market from a price to sales standpoint, a PE standpoint, a cash flow, earnings, you name it. We have a long way to go. But we don't have that euphoria yet from the retail sector, and that won't happen.
You want the jumping up and down. Let me bring in Michelle McCory, who is not jumping up and down, but she certainly has a lot more numbers, and she wants to ask you about some of them.
I'm staying in my seat, Phil, but you raise a very good point because U.S. stocks have been on a tear this year. The Dow up more than 13%, the S&P 500 up 12%, the NASDAQ up more than 10%. Now, historically, stocks have underperformed following May. So, Neil, sell in May and go away, that old adage, should it be applying now? The strategy seems to work very well in the past.
Michelle, where are you gonna go with your money? You're gonna go put it in the EU? I think not. You're gonna go into the BRICS? I think not. You're gonna go into real estate where you can't get the loans, so that's not gonna happen. What are you gonna do? Buy a 10-year U.S. government bond at 1.5%, 1.75% when you can buy the Dow Jones?
But hey, wait a minute, isn't that the problem, Michelle and Neil, is the fact there is no place to put your money because the Fed has rates at zero. People are sitting around with their hands with money earning 0% at the bank and say, hey, you have to invest in the market. Is that fair?
Well, I think when you start to look at it, the yield on the Dow Jones is almost 2.5% versus, like I said, 1.5%, 1.75% for a 10-year bond. So you're better off with high-quality dividend-paying companies. I mean, you can look at Chevron, you can look at GE, JP Morgan, you look at other businesses that are going to do well. But what are companies doing with all their money today? They're doing 5 things. They're initiating dividends, raising dividends, but stock buybacks, putting money in the internal infrastructure, and making acquisitions. Phillip and Michelle, those are great for the stock market. Not good for unemployment, but great for the stock market. That's why you're going to see the market continue to climb, and it's not the time, Michelle, to say sell in May and go away. I think you would lose out on a chance. Now, is the market going to go up 20 or 25% this year? I doubt, but I'm sure it's going to hang around right in here.
Okay, Neil, so the U.S. market's the lesser of all evils, but one thing that should be a little bit concerning is of the companies that have reported so far in the S&P 500, yes, 68% have beat expectations, but only 44% have beat on revenues. So is this telling us that companies are managing to beat expectations because they're cutting down on costs from leaner operations, but not really because they're expanding their sales and their operations? Isn't this a bit of a concern?
Well, I think you really have to step back and use logic and common sense. Would you both agree that this is a slow economy? Yes.
Agree.
Would you both agree that companies are making a tremendous amount of money? Okay. Or would you all agree that they're sitting on tons of cash? Yes. So everything they're doing right now, they don't need to make more money in a slow economy. What they need is something out of Washington to give them some defined rules as to where are we going to go so they can actually go and expand. Because right now, you don't need to expand because your competitors aren't. So there's no cost to defer. Once we get some defined rules out of Washington, be it taxes, healthcare, regulation, then you're going to see companies go higher and expand and beat on the top line. But right now, the way you beat on the top line is you make acquisitions.
Quickly, do you worry about the economy?
No, not at all, because you got to separate out politics, the economy, and what companies are doing.
Okay.
And we're buying companies in the stock market.
Let me help answer some questions. First of all, I always agree with Michelle. And second, I'm happy to blame Washington. Neil Hennessy, thank you very much for joining us. Michelle, as always, thank you.